Hello everybody, welcome to my Daily Dose with Tim. Today is Season 1, Episode 38. And as a lot of you guys know, this week is all about lease option. And a lot of you guys know it as rent to owns, or whatever you want to call it, lease to own, rent to, whatever. And the one thing that we always talk about is the fact that it is called rent to own for a reason. It's not called rent and maybe own, because the whole idea is that we are helping people to make sure that they take the necessary steps that they need to so that they are able to own that property at the end of the rent to own program or at the end of the lease options program. Today though, I'm going to put a focus on the investor side. So I'm going to ask you to put your investor's hat on now and really follow the deal analysis with me. I know for some of you guys, if this is not your first time, it's probably a lot easier to understand it. However, if it is your first time, just remember to come back and watch it a couple of times to make sure that you get yourself up to speed. Because normally I get 3 days to teach this stuff, and this will usually be about a 2 to 3 hour portion, because usually once I go over it once, we were gonna go over it together again, and then you get to practice, and then we practice again, and then there's homework. So just want to make sure that you guys understand. I mean, this is my Daily Dose with Tim, and so I'm gonna do this in a short amount of time with you as quickly as I possibly can, and while maintaining the ability to be clear with you. So let's go, okay? So yesterday we actually got this example set up already, and you probably are familiar with this if you actually watched the episode yesterday. This week started on episode 36, so if you didn't watch the last 2 episodes, this might be a tough time for you to jump in. However, again, if this is not your first rodeo, then it should be okay. Now, the example that we set up yesterday is that, let's say, for example, if you have a tenant buyer now in your back pocket and they've been pre-qualified to be able to purchase up to $380,000 in 3 years' time. So 380 being their option to purchase price. This is why we keep emphasizing on the fact that there's actually 2 portions, 2 stages to this entire strategy. That's why lease option, rent to own, is rent to own and lease with the option to purchase, okay? So what that really means is, yesterday I didn't get a chance to run those numbers. However, what this really means is that this property will likely be located in a market where there's a proven appreciation rate, an overall appreciation rate, usually over the last 10 years, 15 years in that market, of 3.2%. You can find that number either through CMHC or your local realtors in the markets that you want to go into. That makes it a lot easier, okay? Now, we also said that on a monthly basis, this property has a fair market rent of $2,200. Depending on what type of property it is, we already addressed this yesterday. You take the same $500,000 into Vancouver versus to Calgary, to Edmonton, to Saskatchewan, to Winnipeg, to Toronto, all the way to St. John, New Brunswick. The same $500,000 will buy you different types of properties. However, at the end of the day, all things held equal in terms of mortgage qualifications, you're going to be making the same payment usually, right? So we focus on the numbers and helping people get to the finish line. And so what we mean now, what we got to really yesterday was the fact that fair market rent is $2,200. However, on a monthly basis, their monthly payment actually consists of 2 different components. In addition to the fair market rent amount, we're actually helping them do a bit of a forced savings. And this is something that they have to put away with you as an investor every single month. So we have a monthly option consideration because it's an option to purchase contract. So it's an option consideration amount that you are collecting, okay? So we also spoke about the fact that if it's $380,000, even though right now one of the biggest mortgage insurers out there, CMHC, says, well, you know what? Anything less than anything that's less than 95% loan to value, we're gonna have to do a mortgage. We're able to insure it. However, from our perspective, we've always been doing 10%. And I'm pretty sure I've been teaching people how to do this for 8 years now, and we've always been focusing on 10% because there are so many different reasons why people did not qualify in the first place. So we never ever set people up to hit the bare minimum, because just in case the government changes rules, which they almost didn't really happen, or they changed criteria in terms of how people can actually get qualified for a regular mortgage these days in Canada. And so with that being said, $380,000 as the end goal, 10% of that is $38,000. Assuming these guys have some skin in the game, which is $10,000 they've saved up, this now forms their initial option consideration, which will form basically their first right of refusal, and also it solidifies the contract between both parties now. And so what that really means is you have a shortfall of $28,000 that we got to make up over the next 36 months. I didn't have a calculator on my phone with me yesterday. I do today. So 28,000 divided by 36 months, because 3 years of 12 months each, we're looking at about 777.78. Yesterday, I sort of guesstimated at about 785. That also works. For some of you, you might just want to be a bit closer to that number. That's totally fine too. So what I'm going to do now here is change that to 780. So I'm rounding it up by a couple of dollars. Hopefully that's okay with you. So that's 780, which means on a monthly basis, okay, on a monthly basis, they will be paying a total of $2,980, okay? Now, we always say that with every single opportunity that we go into, cash flow is the most important thing, because every single deal, every single property, we treat it as a business, and as a viable business, it needs to be making profit on a monthly basis. So from a property sense, this is exactly the cash flow we're talking about. So if the revenue here is $2,980, I think that's what it was. Let's figure out the expenses to make sure that it actually cash flows, okay? So expenses, typically speaking, in a rent-to-own situation or a lease option, depending on which one you prefer. I keep saying, though, from day one that I like to call it a lease option. However, at the same time, the street name is rent-to-own, which means when it comes to your marketing efforts, maybe it's still easier for you to get more leads coming through to you if you call it a rent-to-own. However, just remember, if you call it a lease option, it makes it a lot easier for you to remember the two components and the fact that it needs two contracts. And also, when you're explaining this to your potential power team members who will be working with you on this strategy, really make that clarification, because there were a lot of people that were not executing lease options properly, and they hurt a lot of people. However, we're not those people, right? I always say there are always good students in bad schools and bad students in good schools too anyway. So how you make your business decisions, how you run this program and run this strategy with integrity, that is your call, not mine. I'm teaching you how to do this the right way and help people get to the finish line, so let's keep going. When it comes to expenses, usually it is a pity payment only. Why? Because your tenant buyers are not your professional tenants. They are not there to call you when a light bulb burns out. They're not there to call you when a toilet gets plugged, simply because of the fact that we also said this is a home ownership and training program for a lot of people. It's the fact that they're not able to qualify for traditional lending right now, and they come to us for alternative lending solutions. However, what that means really is, remember yesterday we also spoke about the fact that instead of looking for distressed sellers or motivated sellers, we're looking for motivated buyers. So these are the people that they're ready to get into the market. However, they got turned away by traditional lending. However, we're able to offer solutions to help them get there. So what that really means is there's a lot of benefits that really come with the strategy, in the sense that the tenant buyers that you're attracting, they usually have a lot more pride of ownership, meaning they take care of the property a little better, which means for you, there's not a whole lot of need for property management. And of course, I always say this every single class, if you're a parent, you probably understand it's better to be strict upfront and flexible later than to be flexible and then trying to be strict afterwards, right? So same idea. We will still encourage you to really stay on top of tenant buyers, usually the first year or two when they're first getting into the program, and you still need to hold their hands, as in you need to make sure that they are following the steps that you're telling them to do, so that they can make sure that between income, credit, and down payment, those 3 criteria are fully met by the end of the 3-year mark here. So they're able to qualify for the mortgage, buy you out, you cash out, they become the owner on title. Happy day for everybody, okay? Now, how do we figure out the pity payment here? So, one of the things that I introduced to everyone, in case you didn't have it already, is the Canadian Mortgage app that you can download on your phone. If you're doing this on your laptop, a lot of the times what we'll use is ratehub.ca. So for my American friends that are watching this, okay, you wouldn't be using the Canadian Mortgage app. Why? Because you guys are luckier in the sense that whatever mortgage rate that you are seeing from your lenders, from your banks, from your mortgage brokers, that's actually the annual rate. Whereas us Canadians, whatever rate we see, that rate is actually compounded semi-annually. So what that means is we actually end up paying just a little bit more in interest over the entire course of the amortization period, okay? So I'm not gonna get into the nitty-gritty of that. Maybe that's a different episode later on. Right here though, when you get into the mortgage calculator, what we can do is punching in the home price. And we already know from yesterday, it's $350,000 at the current purchase price. So let's just say that you are not getting 20% down. I always like to do 25% down. Why? Again, it's about creating buffers. I'm one of those people that, you know what, I would always underestimate revenue and overestimate expenses. Because I love it that way. Anybody's got the experience of, you know, pulling your jeans out of the washer or the dryer and then you find a $20 bill in there and you weren't expecting it, and it's a happy moment, isn't it? And so that's the same philosophy of why I would always overestimate expenses, because if the expenses come out to be a little less, that's like finding free money that you forgot about. So I like that. So 25% down, okay? And then when you click into loan calculation, what you will do is, let's just say because it's a rental, based on today's rates right now, let's just do a 3.89. That's actually on the high end, to be really honest. And I want everybody to basically change that into a 3-year variable for now and amortize. You can amortize over 25 years or over 30 years. And again, not everybody gets 30 years, so I'm gonna do 25 years just to be safe, okay? So if you've got all those criteria in there, then what you're looking at is a monthly mortgage payment, which is your principal and interest of $1,369.68. So as I was mentioning earlier, that I'm just gonna do $1,370. Hopefully that's okay with everybody. I'm basically rounding up the mortgage payment by about 32 cents per month, okay? And then taxes, I'm just gonna give you a bit of a ballpark depending on where this property is sitting. A property that's worth about $350,000 at the moment. Most cities you're gonna be looking at about 1%, so about $3,600 a year, which means $300 per month on property taxes. Insurance, let's just go $120 on a monthly basis, okay? So when we add it all up, let's see if my Asian genes supporting me today. So $1,790. What that really means is if you want to take that number and minus that number right here, you're gonna have 1190, and this number is your cash flow. Okay, this number is your cash flow right there. So here's the thing. I want you guys to think about this. When was the last time you can actually buy a property for $350,000 and cash flow $1,190? This goes back to what I mentioned during the very first, not very first episode, the first episode this week, which was episode 36. Okay, this can build your passive income really, really quickly. Obviously, again, disclaimer, I'm not an accountant. You definitely want to consult a few people in terms of how you want to use that money as cash flow, because usually at this point, I get challenged about the fact that, wait, hang on a second. I thought a part of this or a part of that essentially is their monthly option, which we have to rebate back to them or credit back to them later on. So yes, you're absolutely right. However, there are different ways that you can do this on your books, depending on what your business decision is and your goal in the first place. Okay, your goal is very important. And I'm here to tell you, you can definitely treat that as cash flow, meaning you are allowed to spend it. There are just other precautions that you need to take into consideration. However, this is not a tax course. We're doing deal analysis right now, so let's keep this going, okay? So, $11.90 a month over 3 years. So what that means is over the course of the entire deal, $11.90 times 36, we have $42,840. $42,840. Ooh, I don't know if you can see that. Okay, that's our entire profit from cash flow. However, let's not, whoops, I'm messing this up. So let's not forget about the fact that the end goal is for your tenant buyers to buy this out from you. So what that really means now is we gotta do the math at the very end too. So the day the program completely ends and finishes should be the day that your tenant buyers become the homeowners on title. So I'm gonna put this on the side here. Actually, you know what? I'm gonna start a new page. You just have to bear with me in terms of flipping. So, upon the sale of this property, we know we're selling it back to them for $380,000. Okay, and this effectively is your revenue math at the end of all of this. Not math, sorry, my bad. Revenue number, because that's the amount that you're gonna bank and put into your pocket, right? So $380,000. However, what do you need to pay out? Well, let's take a look. First thing first, do we own this property free and clear? No, we don't. We actually have a mortgage balance. So when you go back to your mortgage app or even on Rate Hub, it will tell you that as well. So at the end of the 3 years, there is a loan remaining of $242,726. So 242,726. I mean, I would probably if I were to be doing this deal myself, I would probably round it up to 243,000. However, just in case this is the number you're looking at, that's totally fine. I don't want to mess anybody up at this point. So let's make sure that that is there, first of all. Second of all, unless you're a lawyer, even though you're a lawyer, you might not even be allowed to close this deal on your own behalf. So what that means is we gotta pay a transaction lawyer or a conveyancing lawyer to finish the transaction for us. I usually just budget $2,000, even though in most markets it wouldn't go up to $2,000 at this point. That being said though, okay, remember the end goal is to also make sure that our tenant buyers have the 10% total option that will turn into their down payment against the purchase of the property. So I know we rounded some numbers. I'm just gonna say if we have $780 on a monthly basis collected from them over 36 months, that means we've collected $28,080 from them over the last 3 years. And in the beginning, it actually came in with $10,000. So what that means is we gotta rebate them back $38,080. This is their what we call total option consideration. And last but not least, this is something that we keep on forgetting, okay, is what we call the initial investment amount. So the initial investment amount is how much money do we actually have to take out of our pockets to get into the deal, okay? Remember, how much in, how much out, how long, and how is my money secured, right? So initial investment, I'm just gonna do a side calculation here, includes your down payment. So we already said $350,000, your mortgage app would actually tell you that. We have to put down 25%, which means $87,500 was the down payment amount. And we had to pay a lawyer to do the transaction for us, okay? And a lot of the times we need to pay for inspection and appraisal. In most cities, it's about $500 on average for each, so $1,000 in total. So under normal circumstances, it is $90,500 to get into this deal. However, let's not forget about the fact that our tenant buyers came with $10,000. So think of it this way. $90,500 is money going out of your pocket, and on the other hand, you have $10,000 coming back in. So really, your net out, so your net initial investment in this case is actually $80,500. $80,500. I'm definitely going over my 15-minute time slot today. Bear with me, okay? I want to make sure that you actually do get the full picture of this. So what that means now is this is the number that we're going to put here. So at the end of all of this now, okay, same idea. You take your revenue, which is $380,000 minus 242,726 minus 2,000 minus 38,080, and then minus your initial investment. And on closing date, you're gonna walk away with a check of $16,694 in your pocket, and you just help somebody realize their dream and goals of home ownership. Great day, right? So $16,640. Let's look at the total profit that was actually made from this deal overall. So let's not forget to add this back in, okay? $42,840. What it'll give us is $48,840. Oopsie, 42,000. So we have a total profit of $59,534 here. That number represents the total profit that we have from this entire deal. So let's figure out how hard has our money been working for us. Okay? So our return on investment on this deal is $59,534. This is how I remembered it. Return on investment, return meaning your total profits sitting on your initial investment. And I believe our initial investment earlier was $80,500. Okay? So let's do that math. Divided by 80,500 and then times 100%. So what we have is actually, let me use blue here. Okay, is 73.96% over 3 years. So divided by 3, you get roughly 24.65% on an annual basis. Okay, so at this point, I just want to ask you guys this. A monthly cash flow of $1,190, first of all, and you buying a property for $350,000, your money's been making 24.65% secured against hard asset, very little to no property management headaches, and you help somebody realize the goals and dreams of home ownership. What's not to like? So I hope you guys followed along. If not, like I said, make sure you go back and watch this again and again until you get it. Obviously, I'm here. If you got any questions, make sure you message me and let me know so I can help you answer that. So the next couple of days, I'll leverage a couple of live deals and jump back into this with you too and speak on about something else on this particular strategy too that I really wanted to share with you, because it's one of the things that really opened up my eyes about this one strategy. So that's it for today. Thank you so much for joining me again. Please like and comment and share this with anybody that you think would benefit from the materials and the content that has been shared with you. I will see you tomorrow. Have a great evening, everybody. Live well.